Hello friends, welcome to this session. The double bottom pattern is one of the bullish reversal patterns that we will explore together. Thanks to friends who watched this video. Different parts of the double bottom chart pattern. 1. Bottom 1. 2. Bottom 2. 3. Neckline, resistance. How a double bottom pattern is formed. Double bottom is a reversal pattern formed by two consecutive lows that are at the same level. A slight difference in values is allowed, and an intermediate high between them. It is expected that after the price again reaches the level of the first low and then turns around and goes above the intermediate high level, further price growth is expected to continue further by about the difference between the lows and the high. A double bottom pattern is a price chart formation that appears at the trend low and signals a soon price movement reversal up. This chart pattern belongs to the price action technical analysis technique, which involves analyzing price movements without using additional technical indicators. The essence of the double bottom chart pattern lies in the name. The pattern is characterized by forming two bottoms located approximately at the same level. Between these two lows, there is a small upward correction, which gives the pattern the final look of the letter W. How to identify a double bottom? 1. Prolonged downtrend. Before the formation, there should be evidence of a significant downtrend. 2. First bottom formation. The price creates a notable low, which will represent the first bottom. 3. Intermediate peak. Following the first bottom, there's a price rebound that establishes a peak, often referred to as the neckline. 4. Second bottom formation. After the rebound, the price drops again to form a second bottom. This should be roughly at the same price level as the first, indicating a strong support level. 5. Break above neckline. For the pattern to be confirmed, the price should subsequently rise and break above the neckline formed by the intermediate peak. 6. Volume analysis. Ideally, the volume should decrease during the formation of the second bottom and increase during the breakout above the neckline, solidifying the pattern's validity. Double bottom pattern trading tips. Look for double bottoms only in a downtrend, as this is a reversal pattern that forms at a low. Double bottom patterns can be detected in any type of market. Employ candlestick chart analysis to get additional reversal signals to buy, such as hammer, morning star, bullish engulfing, and other candlestick patterns. Before you enter a buy trade, make sure that the price has broken out the resistance level, consolidated above, and tested the level. Enter a long trade when the market bounces higher. Follow risk management rules, and observe the rules to enter and exit trades according to the double bottom patterns. 7. Enter a trade only after you received several buy signals from different technical analysis tools. double bottom patterns can appear on various time frames. Shorter time frames, 15 minutes, 1 hour, may provide more opportunities but are also more prone to false signals. Longer time frames, e.g. 4-hour, daily, may offer more reliable signals but fewer trading opportunities. Activity of big traders during the double bottom formation. 1. Accumulation phase. The first trough of the double bottom can be seen as a point of interest where institutional traders identify a value proposition. Their initial buy orders at this stage prevent the price from plunging further, leading to the formation of the first bottom. 2. Testing the waters. As prices rebound and then come back down for the second trough, institutional traders are essentially testing the waters. They want to ascertain that the price level of the first trough is a genuine support level, and they'll defend it again. This second confirmation provides a more concrete evidence of their bullish sentiment and commitment to the price level. 3. Bolstering momentum. As the price approaches the neckline after the second trough, big traders typically ramp up their buying activity. Their large volume purchases, often detectable through a surge in trading volume, help propel the price through the neckline, triggering the bullish reversal. For positioning ahead of retail, institutional players often anticipate the pattern formation and position themselves ahead of retail traders. By the time the majority of retail traders recognize the pattern and respond, big traders are already positioned favorably, capitalizing on the subsequent price appreciation. Examining the advantages and disadvantages of a double bottom. Advantage number 1. The double bottom pattern is a bullish reversal pattern, much as the double top pattern. It develops following a downward trend and indicates that the trend may be changing to an upward trend, offering prospective purchasing opportunities. Disadvantage number 1. Not all double bottom patterns result in notable price reversals, just like the double top pattern. It's possible for some patterns to fail to manifest, producing wrong signals. Double bottom patterns can be subjectively identified, just like any other technical pattern. On the precise details that characterize the pattern, traders could disagree. Advantage number 2. The double bottom pattern gives distinct entry and departure locations, just as the double top pattern. The exit point can be chosen depending on the anticipated price increase, while the entrance point is frequently placed above the neckline. Disadvantage number 2. The study of the double bottom pattern must be done within a specific time frame. Compared to shorter intraday time periods, it performs better in longer time frames. Despite the fact that the double bottom pattern suggests a probable reversal, it cannot be used to determine with certainty the size or timing of the price gain. Advantage number 3. The pattern's authenticity may also be verified via volume analysis. As selling pressure lessens, the volume of the second dip should ideally be lower than the volume of the first. Confirmation tools for the double bottom pattern. Technical indicator divergence, bullish divergences on oscillators. Example RSI or MACD can further validate the pattern's bullish implications. High volume surge. An increase in trading volume during the neckline breakout emphasizes the momentum behind the reversal. Best time frame. For optimal clarity and reliability, the daily and 4-hour charts are most favored when spotting the double bottom pattern. How to trade the double bottom pattern? Entry strategy. Primary entry point. Enter a long position when there's a confirmed breakout above the neckline. Stop loss placement. Set the stop loss just below the second bottom. This ensures that if the pattern fails and a new low is created, the position is exited with minimal loss. Take profit level. Calculate the distance, height, between the neckline and the bottoms. Project this distance upwards from the breakout point at the neckline. This projection gives a potential price target. Example 1. Currency name DXY. Identify a double bottom pattern, one prolonged downtrend. Two first bottom formation. 3 intermediate peak. 4 second bottom formation. 5 draw the neckline. 6 break above neckline. Technical indicator divergence, bullish divergences on oscillator. One, entry strategy. Two, stop loss placement. 3. Take profit level. Example 2, currency pair EUR/USD. Identify a double bottom pattern, one prolonged downtrend. 2 first bottom formation. 3 intermediate peak. 4 second bottom formation. 5 draw the neckline. 6 break above neckline. 'Technical indicator divergence, bullish divergences on oscillator. 1. Entry strategy. Two. Stop loss placement. 3. Take profit level. Example 3, currency pair GBP/USD. Identify a double bottom pattern, one prolonged downtrend. 2 first bottom formation. 3 intermediate peak. 4 second bottom formation. 5 draw the neckline. 6 break above neckline. 'Technical indicator divergence, bullish divergences on oscillator. One entry strategy. Two stop loss placement. 3 take profit level. 4 gold. Identify a double bottom pattern, one prolonged downtrend. 2 first bottom formation. 3 intermediate peak. 4 second bottom formation. 5 draw the neckline. 6 break above neckline. 'Technical indicator divergence, bullish divergences on oscillator. One entry strategy. Two stop loss placement. 3 take profit level. 5 stock name AMD Advanced Micro Devices. Identify a double bottom pattern, one prolonged downtrend. 2 first bottom formation. 3 intermediate peak. 4 second bottom formation. 5 draw the neckline. 6 break above neckline. 'Technical indicator divergence, bullish divergences on oscillator. 1. Entry strategy. Two. Stop loss placement. 3. Take profit level. 6. Stock name, NELX, Netflix. 1. Prolonged downtrend. 2. First bottom formation. 3. Intermediate peak. 4. Second bottom formation. 5. Draw the neckline. 6. Break above neckline. 'Technical indicator divergence, bullish divergences on oscillator. One. Entry strategy. Two. Stop loss placement. 3. Take profit level. 7. Currency name, STS.P. Identify a double bottom pattern, 1. Prolonged downtrend. 2. First bottom formation. 3. Intermediate peak. 4. Second bottom formation. 5. Draw the neckline. 6. Break above neckline. 'Technical indicator divergence, bullish divergences on oscillator. One. Entry strategy. Two. Stop loss placement. 3. Take profit level. Example 8. Currency name, EGLAS.P. Identify a double bottom pattern, 1. Prolonged downtrend. 2. First bottom formation. 3. Intermediate peak. 4. Second bottom formation. 5. Draw the neckline. 6. Break above neckline. Technical indicator divergence, bullish divergences on oscillator. One. Entry strategy. Two. Stop loss placement. 3. Take profit level. What is the head and shoulders pattern? A head and shoulders pattern is used in technical analysis. It is a specific chart formation that predicts a bullish to bearish trend reversal. The pattern appears as a baseline with 3 peaks, where the outside 2 are close in height, and the middle is highest. Left shoulder, price rises, forms a peak, then falls. Head, price rises again, forming a higher peak. Right shoulder, price falls again, then rises, but forms a lower peak than the head. The neckline is a trend line drawn horizontally connecting the low points of the left and right troughs, the shoulders. The neckline serves as a critical level of support. If the price breaks the neckline and closes below it, the pattern has completed. The head and shoulders pattern forms when a price rises to a peak and then declines back to the base of the prior up move. Then, the price rises above the previous peak to form the head, and then declines back to the original base. Finally, the price peaks again at about the level of the first peak of the formation before falling back down. The head and shoulders pattern is considered one of the most reliable trend reversal patterns. It is one of several top patterns that signal, with varying degrees of accuracy, that an upward trend is nearing its end. A head and shoulders pattern has 4 components. 1. After long bullish trends, the price rises to a peak and subsequently declines to form a trough. 2. The price rises again to form a second high substantially above the initial peak and declines again. 3. The price rises a third time, but only to the first peak level, before declining again. 4. The neckline, drawn at the 2 troughs or peaks. Advantages and disadvantages of the head and shoulders pattern. Advantages. 1. Experienced traders identify it easily. 2. Define profit and risk. 3. Big market movements can be profited from. 4. Can be used in all markets. Disadvantages. 1. Novice traders may miss it. 2. Large stop-loss distances possible. 3. Unfavorable risk-to-reward possible. Advantages explained. 1. Experienced traders identify it easily. The pattern is very recognizable to an experienced trader. 2. Define profit and risk. Short and long entry levels and stop distance can be clearly defined with confirmation openings and closings. 3. Big market movements can be profited from. The time frame for a head and shoulders pattern is fairly long, so a market can move significantly from entry to close price. 4. Can be used in all markets. The pattern can be used in forex and stock trading. Disadvantages explained. 1. Novice traders might miss it. The head and shoulders pattern may not present with a flat neckline. It may be skewed, which can throw off new traders. 2. Large stop-loss distances possible. Large downward movement over long time frames can result in a large stop distance. 3. Neckline can appear to move. If the price pulls back, the neckline might be retested, confusing some traders. Hey, welcome to the double top pattern session. The double top pattern is one of the bearish reversal patterns. The double top pattern consists of three parts: first peak, top 1. The second peak, top 2. Neckline, support. How a double top pattern is formed. Double top is a reversal pattern formed by two consecutive highs that are at the same level. Slight difference in values is allowed, and an intermediate low between them. It is expected that after the price again reaches the level of the first high and then reverses, and falls below the level of the intermediate low, the fall will continue further by about the difference between the highs and the low. A double top has an M shape and indicates a bearish reversal in trend. Key elements of a double top pattern. 1. Uptrend. The price should clearly be moving upward before the pattern forms, as seen by higher highs and higher lows. 2. Two peaks. The pattern consists of two peaks that roughly correspond to one another in terms of price. These peaks serve as resistance levels where the price stalls and begins to fall. 3. Trough or valley. A trough or valley has formed between the two peaks. This denotes a brief period of price decline or consolidation. 4. Neckline. Support. The neckline is a horizontal line that is created by joining the valley or trough low points. It serves as a degree of support and is essential for confirming the pattern. 5. Break of neckline. The break of the neckline is a key component of the double top pattern. When the price drops below the neckline, suggesting a potential trend reversal, the pattern is verified. 6. Volume. Volume can add to our understanding of the pattern. Volume often increases when the price breaks below the neckline and decreases throughout the creation of the two peaks. The validity of the pattern may be strengthened by this rise in volume on the breakdown. 7. Price goal. After the breakdown, project distance downward from the neckline. This can offer a rough point of reference for the price decline. How to identify a double top? 1. Look for an upswing. The price movement should be clearly in an uptrend prior to the creation of a double top. This indicates that the price has been making continuously higher highs and higher lows. 2. Find the initial peak. Determine the uptrend's first peak. The price has now risen to its maximum level before beginning to fall. 3. Find the trough. Following the initial peak, the price will briefly fall. Find the valley or trough that develops following the initial peak. 4. Find the second peak. The price will then rise once more in an effort to hit a new high. But this second rally will fall short of the first peak's height and begin to collapse once more. 5. Draw the neckline. Connect the low points of the two troughs with a horizontal line. This is the neckline, which denotes a level of support. It serves as an essential pattern reference. 6. Verify double top pattern. To verify the double top pattern, watch for a price break below the neckline. Breaking below the neckline might be interpreted as a sell signal because it portends a potential trend reversal. 7. Verify the pattern. To verify a double top pattern, make sure the decline that follows the second peak is lower than the trough that follows the first peak. This demonstrates that the previous resistance level was not successfully overcome by the price. Examining the advantages and disadvantages of a double top. Advantages: allows traders to use visual patterns to trade. May indicate clear resistance levels. May communicate clear entry and exit points. May be confirmed by the volume of shares traded. Disadvantages. Like any chart pattern, it may indicate a false signal. May rely on subjectivity in identifying patterns. May result in slightly different variations across investment. May result in limited profit potential. Advantage. Number 1. A double top pattern is a visual cue of a possible change in trend from an uptrend to a downtrend. For traders hoping to profit from a shift in the market's trajectory and seize fresh profit possibilities, this can be favorable. Disadvantage. Number 1. The double top pattern is not infallible. Like any other chart pattern, it occasionally generates false signals. A failed double top pattern could develop if the price briefly forms two peaks before continuing its upward trajectory. The breach of the neckline and other supportive signs should serve as confirmation, therefore traders should proceed with caution. Advantage. Number 2. Plus, there's often a definite resistance level that is formed when two peaks at roughly the same price level appear consecutively. This level can be used by traders as a benchmark for establishing stop-loss orders and profit objectives, improving risk management, and trade planning. Disadvantage. Number 2. There may be some subjectivity involved in recognizing a double top pattern. The positions of the peaks and troughs, as well as how symmetrical the pattern ought to be, may be interpreted differently by traders. This subjectivity may cause discrepancies and a range of outcomes among traders. Advantage. Number 3. A good entry point for traders to start short positions is the break of the neckline in a double top formation. If the price does not break below the neckline, this provides a fixed level at which to enter the market and aids in determining the pattern's invalidation. The height of the pattern can also be used to predict profit targets, giving traders a distinct moment at which to exit. Disadvantage. Number 3. It's possible that not all double top patterns have exact symmetry or the same peaks and troughs. The pricing ranges, length of time, and shape of the design are all flexible. It can be difficult to precisely specify the entry and departure locations or establish the pattern's target levels because of this variability. Advantage. Number 4. Volume analysis can offer more assurance of the correctness of the pattern. Volume frequently rises when the price breaks below the neckline and decreases throughout the creation of the two peaks. Disadvantage. Number 4. A double top pattern's downside goal is normally calculated by extrapolating the pattern's height from the neckline. However, relative to the starting risk or stop-loss level, the possible profit target can be constrained. Depending on the state of the market, the price can not always reach the predicted target, producing lower earnings than expected. Advantage. Number 5. The signaling potency of the pattern may be further enhanced by this volume increase. Therefore, in some ways, a double top can be a more predictable, reliable pattern compared to other strategies. Advantage number 6. Last, by spotting a double top pattern, traders can determine their profit goals and determine the probable downside target depending on the pattern's height. Due to the fact that the potential profit goal is often higher than the original risk stop loss, this usually provides a good risk-reward ratio. How to trade a double top? There are 3 primary ways to trade a double top. First, you can wait for the price to cross below the neckline, which would confirm the double top pattern and perhaps signal a trend reversal. You can start a short trade or sell position after the break happens. To reduce risk, think about placing a stop-loss order above the most recent swing high. You can also project the vertical distance between the neckline and the highest peak downward from the neckline to determine your profit target. Second, after the neckline is broken, the price may occasionally retest it from below before continuing its downward movement. A profit target can be established using a variety of techniques, including projecting the pattern's height downward or locating probable support levels. The stop loss can be set above the most recent swing high. Third, you can use extra technical indicators or oscillators to make the double top pattern more reliable. For instance, you can check for bearish divergence on the moving average convergence divergence (MACD) histogram or the relative strength index (RSI) when the indicators display lower highs as the price develops the 2 peaks. Following the stop-loss and profit target criteria described above, you can place a short trade once the neckline is broken when the indicators confirm the bearish signal.